started now. Hello, everyone. Thank you for signing up. Most likely, you've attended one of our webinars before. If you haven't, my name's Alex Wilson, broker owner of Remax Wealth Builders Real Estate. Below me, co-founder of Remax Wealth Builders Real Estate, or beside you, depending on how it's on the screen, Kyle DeVigi. And then we also brought in Amit Puri as well, mortgage professional. Everything I talk about today, unless you have the cash in the bank, you're gonna need Amit to help you out with that. So if you haven't had a chance to watch our previous webinars where we talk about leverage wise and the advantage of leverage, we have a whole month worth of webinars on the Insight tab of our webpage at remaxwealth.com. Look for the webinar on leverage wise. We have a whole month worth of conversations with Amit talking about how to use leverage profit wise. And that's where we see opportunity now in the market where there is softness. So this is where you can take advantage of existing leverage or cash, because there are cash opportunities, existing leverage or cash to take advantage of these opportunities. So when we say, actually, you know what, Kyle, you know what we just, I'll have Kyle jump in. Kyle, why don't you discuss, we did a piece recently with the mail out wise 2019, end of October 2019 versus end of October 2020, and the stats specifically downtown. So we're focusing this conversation on downtown wise. That's where we see the biggest opportunity. And downtown is defined as C1, C8, which is south of Bloor, east of Dufferin, and west of the DVP, and north of the lake. So Kyle's just going to give you some stats, and then we'll go into why we see a big dip coming.
Yeah, thanks, Alex. Because we've heard in the news and a lot of people talking, there's increased inventory. So we wanted to actually go in and check the numbers ourselves. So we went onto Treb and we did a lookup comparing the last week of October 2020 to that exact same time in 2019 to see, exactly where we stood, knowing COVID's been around for about 6 months and seeing the impact there, and adjusting for seasonality, which is why we wanted to do year over year. So available for rent this time in 2019, there were about 1,465 units available to rent in the downtown core. When you compared that to that same time this year, there were about 6,900 units available in the downtown core, which is a year-over-year increase of about 370%. So very significant increase on the rental side. So then we also wanted to see, how is this impacting the sales side? Because rentals are one thing, what's the resale market like? So in 2019, there were about 700 units available to purchase in the downtown core. Fast forward a year, in 2020, there were almost 3,000 units available to purchase. And that's about a 330% increase. So a little bit less than the rental market, but you can see that COVID has definitely affected both the rental and the resale market downtown.
And the reason for that is that there's no reason for anyone to live downtown right now. Office buildings are closed, which they'll realistically be closed till summer 2021. International students, that number has decreased significantly over previous years because of border situations and travel and everything. Immigration is way down. And then just the lifestyle that downtown has to offer in regards to going to restaurants, literally closed in Toronto right now, other than going to patios and eating outdoors, but the indoor restaurants are closed. Live events, whether it's concerts, sporting events, exhibitions, none of those exist. You can't have large gatherings wise. And obviously the going to work is living downtown. You want to live close to work. None of that exists right now. So why do people need to live downtown right now? They don't. The people obviously still live downtown. They choose to live downtown, but no one needs to live downtown right now. So what do we see? We see increased number of units rent, vacancies going up, rental prices going down because vacancy prices are going up, and the number of listings are creeping up on the market wise. And what we expect to see over Q4 2020 into Q1 2021, those nearly 7,000 units that are available for rent currently right now in downtown Toronto, they are either going to have to drastically continue to reduce their rental prices they're going to sit empty, or the landlord's going to be like, you know what, I've made enough money, I'm going to put it on the market for sale wise. So we'll see increased inventory coming on the market for sales wise because of the landlords deciding maybe I want to unload my unit instead of holding on to it and dealing with all the tenant issues that come with that currently wise. And because you're going to have even more increased inventory for sale coming on, you're going to see downward pressure on pricing in the resale market. Now, do we think that this is going to last forever? No, this is a very acute phenomena. International students are going to come back. That hasn't changed. Immigration levels, and very, very importantly, immigration levels. Immigration levels, they've already announced that they want to push that to record levels ever in Canada-wise, over 400,000 in 2021, increasing in 2020 and 2023. And here's the key thing that everyone needs to know. Our economy runs on immigration. It is a vital part to growth through our economy wise. So it's not just a fancy number that they're putting out there. You know, they need this immigration to come in to bring skilled labor, wealth. You know, immigrants that come in these days aren't poor. You know, they come in, they can bring their skills, but they also bring their money as well. So they bring their skill, they bring their labor, and they bring their wealth over as well. So that is critical to the economic recovery from COVID in our economy wise. And where immigrants land, the majority of immigrants land up is actually in the Greater Toronto area. If you watch any of our past videos and everything that we were talking about why Toronto is a good place to invest, well, that exists. It's just on pause right now because of COVID-19. All those will continue to exist after. And the reason immigrants come to Toronto is that, well, we're the population base of Canada in the Greater Toronto area. We're the economic base of Canada. 20%, nearly 20% of the GDP for all of Canada happens in the Greater Toronto area wise. And we're the most multicultural city in the world. So if I'm coming to a new country to set up roots, well, where are the jobs going to be? Well, this is the economic capital of Canada. Okay, the jobs are going to be in the Toronto area. This is where the population base is. And then 3, because we're the most multicultural city in the world, most likely we'll have family or friends, or at minimum, culturally wise, you'll have a community that you can easily not immigrate to, immerse yourself into. So those things all exist and will continue to exist. They're fundamental things of the city of Toronto wise.
And Alex, I want to put some numbers to that statement as well, where according to the immigration numbers, 70% of recent immigrants land in Canada's 3 largest cities, Toronto, Montreal, and Vancouver. We're going to start seeing that pushing more into Calgary, Canada's 4th largest city, quite significantly as well. 60% of the people they're looking to allow into the country next year, 60% of those are going to be of the economic class. So they're bringing skilled labor. They want to start businesses. They want to get that economy going. And these people are going to do that. And immigrants have been proven time and time again to be very good at starting businesses and creating economic growth. About 100,000 of those immigrants are going to be of the family class as well. So bringing over different people, parents, siblings, grandparents into Canada as well. And that just grows the economy as well. And only a very small portion of new immigrants are going to be refugees or humanitarian purposes. So, the vast majority of immigrants are going to be contributing to the economy, growing the economy, and these sorts of people are going to rent when they get into the city first, and then eventually are going to purchase. We see time and time again, many of these immigrants, they're not afraid to purchase property. They see that as a great long-term investment, and they're the ones, often buying multiple properties, and we work with many investor clients like that.
And I'll even add that. So that's a great point, talking about new Canadians investing in properties. The countries they come from, they may not even be able to buy real estate. Like the ability to own multiple properties without a consequence from the government is not a worldwide phenomena wise. It's more of a westernized phenomena, and there really are no restrictions in Canada, other than certain areas where there's a foreign buyer tax, this being one. But it is like when you have these new immigrants coming in, and the advanced nature of our mortgage markets wise, which Amit can attest to and everything like that. these structures don't exist in other countries. Why? So when you come here and you see these opportunities and you're like, this is easy compared to what I used to have to deal with. Wise, I'm dealing with bribes. I'm dealing with no regulations. I'm dealing with, when there's a regime change, everything changes and I may be wiped out. I hear everything is safe and boring. And
just to pipe in on that as well, like the banks across the channels, from Scotia to TD to Royal to BMO, you name it, they've all also introduced tons of new programs for new to Canada immigrants. Something that we didn't used to do years ago was mortgages for people on a work permit, and we've started doing those. So you're also seeing the financial sector welcome these immigrants, whatever status they may be, with the exception of refugee, as allowing them to get mortgages. And whether it's 5%, 10%, or 20% down, we've seen a huge spike in clients. I think as long as the country that they come from is not a high risk country, so the UK's, Hong Kong, Singapore, Iran, Dubai, certain countries in Africa, they're allowing it. There's obviously some countries that the banks don't like to see money coming from, but on the whole, I would say 95% of foreign countries are game. It's been working.
Yeah, and what I'll also add this, and this is important, relevant to the profit on the recovery and the buy short things that we'll be discussing. But we think of, and when I mean we, individuals that currently live in Toronto, everyone on this call, if I'm buying a piece of real estate, I'm like, what's my return on investment? How much money am I going to make? There are individuals that invest in our safe markets because they're preserving wealth. So it's not a game of how much money am I going to make. It's, I want to make sure that I've moved my wealth into a safe asset wise. And I know when I go back to that asset, that wealth is still going to be there. Someone hasn't taken it away from me. And that's something that we see from other individuals from different countries wise. Toronto real estate is like gold to some people wise. And what I mean like gold, it is an asset class, a hard asset class that's used to preserve the wealth and protect individuals' wealth. But the advantage of Toronto real estate over gold is that I can actually attach an income stream to it. There's no income that I can attach to gold wise. The income stream that I attach to Toronto real estate is actually a body that's going to live in the property and pay me rent for the property wise. And why we specifically focus in on condos wise is they're concrete boxes in the sky and they're incredibly easy to manage versus getting into multi-residential or houses and everything like that, where there still can be lots of money to be made. They're just a lot more work. We find it's more scalable to do condos wise. And specifically now, condos, which are seeing a decline in prices wise, that's where the great opportunity is. Housing's up. Housing's up in Toronto. Housing's up in you name the community other than downtown Toronto, it's up. You go to Kitchener-Waterloo, you go to Guelph, you go to Cambridge, you go to Hamilton, you go to St. Catharines, you go to Niagara, you go to Windsor. Houses up, 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 up. So where you always want to focus on is where is my down opportunity, where there has been historic growth levels. So again, that's what the whole purpose of this presentation is today, is to talk about that. We discussed, okay, so rental listings are up, listings for sale are up. We expect those rental listings, some of those to move to the sales market, which put more pressure on sales prices wise. It's going to be a very long winter. And because of this, we expect prices to fall further wise. Could be an additional 5%, could be an additional 10%. But the key thing is looking at it being down off of the March 1st pricing of 2020. So we went on a tear January, February up to March. Condo prices were going up like this. COVID, then we saw things go down. So there's already built-in profit in the condos in the downtown core. And we also discussed that, well, you know what? People are going to be going back to living in condos wise when things get back to normal. I'm sure everyone here likes going to concerts, sporting events. Being close to work is a huge advantage wise. And speaking of being close to work, this is what I actually expect to see what happen. There is one that will lag in the recovery. I don't think condos are going to lag, but public transportation, I expect to lag. Kyle, do you remember taking the Yonge subway line?
Oh God, yes.
And even the Bloor subway line, not just Yonge.
And a transfer at Bloor and Yonge during rush hour.
So I can't imagine any people rushing to go get back on subways where you are lit at rush hour. You're like this. If you're able to get on a train, you may have to wait a couple trains to get on, and then when you're on, you're like this. So everyone is face to face like this. That won't, even with the vaccine, that is going to take some time to reprogram individuals to feel comfortable in that environment. That may take a few years. So if we look back to condo living, specifically in the downtown core, where the concentration of jobs are in the downtown core, people are going to want to live closer to work because they're going to want to be able to walk to work. And if they walk to work, they're able to avoid the public transportation, or they're going to bike. Kyle was before he became selling, he would bike to work. So I think biking is going to be a huge boom post-COVID wise. As people migrate back to work, and also living close to work is going to be a huge boom as well. And that's going to be very, very important. And that's a positive for the condo market. So for my condo investors that I know, just looking at the screen, David, Jason, that have those central downtown property wise, I think we're going to see a big bump in those. So my time frame for everything. So Q4, Q1, this in pricing, Q2, 2021, a leveling off of that's getting into the spring market wise, getting into Q3 into the summer wise. I expect prices to start going up, and then a full recovery in pricing back up to March 1st levels in 2022, and then basically then you'll see the regular increases that we had before from 2022 on. Now there may be the proponents out there going like, well, who's going to go back to the office wise? I go to the office for the most part every day if I'm not on the road. If I have things that are on the road, that kind of thing. I'm at the office right now. I know Kyle is at the office, our office right now, which is located downtown core. I am actually not at the office today because I have a cold, but I'm always at the office wise. I know people dying to get back to the offices wise. Their offices just aren't open yet. There are people that are enjoying working from home, but what you lose is the collaboration aspect with individuals within the office space and everything like that. There is a segment of the population that will continue to work from home. That will happen. But in regards to the mass exodus of individuals in the office, that is not happening wise. Everyone that writes that does not have young children, which I have, which Amit has. So that there, people will go back to the office wise. Now, will it be some sort of hybrid environment? 100%. I think the idea of working 5 days a week in the office wise, there will be flexibility to that. There will be no employer that is going to be so rigid on the 5 days a week work week. But there will be flexibility with that. Kyle, your wife, why don't you talk about, just in regards to, she's in the pharmaceutical industry and regulation and everything. Why don't you talk about her experiences working away from the office and the collaboration in the office wise, and just what can get done?
Yeah, so this was something that she found actually pre-COVID, because she works with a global team. So she's on conference calls, constantly. That's part of her regular day job. And, they try to advance projects, do what you can over the phone, trying to balance everyone's time zone. It's difficult working with San Francisco and Switzerland and England and Canada. Trying to find times when everyone works is always a challenge. So they would, get together for face-to-face meetings, throughout different times of the project. And what they always found was in those couple days, 3, 4, 5 days together, they would advance those projects in those few days more than they had in 6 months through the conference calls, just because everyone's dedicated to it, that collaboration together. You can quickly advance things without having to wait for someone to respond. You build momentum and you feed off of that, and you can leapfrog on your progress very easily when you're face to face, something you're not able to do over conference calls, over Zoom. That collaboration aspect is missing. And you have other big employers like Goldman Sachs saying, we're really missing that from the work and home environment. And they're really pushing to get everyone back in the office as soon as they can. But obviously, COVID has made that challenging. My wife's not going back to work until 2021 at the earliest. But it is something that is definitely being recognized by major players out there.
And I'll also add this, 100% are people more productive at home? Yeah, and that even post-COVID wise, or sorry, pre-COVID wise, there were studies that dictated that. It showed that there was an increase in productivity when people were working from home. And there are some advantages to working from home, but the collaboration aspect, so you can shred water at home. Shred water, you'll see a bump in productivity. But to make the jump, that jump that you want your business to get to the other side of the bridge, that takes the collaboration, that takes the brainstorming, that takes people meeting together. Having that, you're not going to be able to make the jump. So you can shred water, you can see a bump in productivity, but to make the jump, you're not going to be able to do without that collaboration aspect, which is so important. Why? So again, that's where you're going to see people go back to work wise. So that's where we.
I would also like to say that, based on a lot of clients we've dealt with, a lot of downtown workers, a lot of staff, a lot of salaried people. Like in the original days of COVID, the silver lining, if you want to call it, was people got to catch up on admin work and stuff that they weren't finding time for. It was a nice break for some people where the hustle and bustle of the city was gone. But you fast forward 7 months now, and there's this sort of fatigue that has set in, where I agree with you 150% that you can get stuff done, but to actually go to the next stage of the business strategy, that can only be done in person. And even now, even in our office, like when we need to get stuff done, we do still have to have a meeting. You cannot do everything over email and via Zoom, and it's just not something that's going to happen. And everything you've hinted to is just a matter of time. It's not. This is not a forever approach. I think what's going to change is maybe the intensity of people going downtown. I know I've heard that, if 100 people are working at a company, then they'll have 30 come in Monday, 30 Tuesday, 30 Wednesday, but then that still requires space and time and log, and everyone's going to be coming back and forth. So there is going to be a change in the approach. Maybe some businesses have learned that, just as an example, like Royal Bank has 80,000 employees. Maybe they've learned they only need 40,000 downtown instead of 80. So and those 40 that are missing, they'll get replaced with other businesses that are booming, like tech companies like Google and Amazon and, HelloFresh and all these food, like whatever businesses are down, other businesses will prosper. So, and then we can't forget about what you said with immigration, right? The world population is going from 7 billion to 10 billion. Those 3 billion people got to go somewhere in the future. So, and that's where Toronto is a perfect hotspot.
Yeah, and I'm gonna add another story, and then this is a story we tell people again pre-COVID wise. I've said it for years. I'm graduating from university. I have 2 job offers in front of me, one for Coke, one for Pepsi. Pepsi's location is right by the airport. Office location, Coca-Cola is downtown. Pepsi offers me $10,000 more. But Coke's located right downtown. I'm taking the Coca-Cola job because I want to live right downtown. The vibrancy of the life, again, living downtown, versus living in a suburban area wise, that lifestyle aspect isn't there. So again, that is to come back. That has been around for decades on decades on decades. You can look at major centers across the world. So that's again where it's very, very acute what's happening right now. Yeah, when you shut everything down, okay, people aren't going to want to live there, but everything will open back up again. This is a very short period on a long-standing projection on everything. So that's getting into there. Now, talking about where the opportunity is, there's two tracks you can take. You can buy short or buy long. Short model is okay. What are the opportunities that are on the market today? So that's where you're going to be investing in a resale opportunity wise, where someone is looking to unload their unit, and we're seeing pricing off, could be $100,000 or more from that March 1st pricing wise, but we expect that pricing to bounce back by 2022. So within a short period wise, you can profit off the dip by buying on the short term wise. And where those opportunities present themselves is literally looking under rocks wise. So talking about collaboration, you know, we talked about, Emmett was asking me at the beginning, he's like, oh, you're going to jump on that unit wise. That unit, the only reason I know about that unit, the opportunity is I went to the office and someone knocked on my door, another agent I know going, hey, Alex, you do a lot of work. I know you have a very, very large database of individuals. Here's my situation. Do you have anyone interested in this? I'm not marketing this out to anyone, but I know I'll tell you in confidence that I can get you this deal. Do you think you have someone that's interested? That came from me being in the office. If I wasn't in the office, I wouldn't have known about this. And that came from a relationship and my success that I had. So that was there, someone jumping on that opportunity. Another one that I saw was just a mislisted unit in a building wise. And I'm like, that's not right. That unit has 2 washrooms, not 1 washroom. And I know the layout of the building, it's that unit really is a 2-bedroom unit wise. And I'm getting that for a 1+10 pricing wise, and it had parking. This is an incredible deal. Now that unit is since sold, but it was an incredible deal as a penthouse unit. So it's that insider knowledge, lifting up the rocks, knowing specific units, knowing the backside of units wise, where there could be some shakiness in the confidence of the owner of that unit, where you can uncover these opportunities wise. And that's where you get to take advantage of the buy short. On top of that is on the buy short model, you're dealing with record low interest rates. So yes, your rent is going to be lower. I am not getting you summer 2019 rental prices. That's not happening. You know, peak wise, I personally, my own inventory, I had a unit rented for 2,300, a 1-bedroom wise. I'm probably getting 1,700-1,800 for that if I were to lease that out today. I did have to renegotiate that rent with the tenant once their lease came due. They stayed, so I'm going to be getting less rent, but I'm compensated by that. My interest rate on that mortgage is 3%. The interest rate on that mortgage today would be sub 2%. You know, depending on what you get, whether it's a fixed product, whether it's a variable product wise. So I get a savings on the interest rate wise. That's not going to compensate the full loss of the rent wise, but I may be underwater $100 or $200 per month on the property. So let's say it's $200 per month. Just do simple math. 200 times 12 is $2,400. So I'm going to be negative cash flow at 2,400, but part of that is principal pay down on the property wise. So just out of my bank account, I'm going to be less $2,400, but that property has gone up $100,000. So by taking a hit of 2,400, but the property has gone up 100,000, that seems like an incredible investment. Does that sound like a good investment to you guys?
It's a no-brainer.
So yes, your rents are down, but the pricing is down because you have people's confidence going to be shaken throughout the winter. It's going to be a very cold winter. I don't mean outside, it may be cold. I don't know what's going to be like this year, but it's going to be a cold winter in regards to, there's not going to be a lot of positive news coming out of the condo market, I expect, over the winter months, especially as infection rates go up and everything like that. So that's where the opportunity is. But we know that the rental prices will not stay like this. So if we take the short-term hassle of dealing with a lower rent and maybe a little bit of vacancy and getting it rented out, you're going to see a huge reward on the appreciation of that property in a very, very short period of time, expected in 2022, 18 months. So I'm looking at spring for the full rebound in pricing wise. That's typically what we see in the market wise. So what we'll be doing is every week we'll be analyzing the market and sending what we think are good opportunities on the market wise and doing a little bit of analysis for you to show you, hey, here are the units, here's why we like this, here's our expected property wise, and we'll be sending those out because not every unit is going to be a good buy. There are units that are going to be good buys and units aren't going to be good buys. And here's the secret sauce. Should we tell them the secret sauce, Cal?
I think so.
Okay, you tell them this. I'll let you tell them the secret sauce. What buildings, to narrow all the buildings down, what buildings should they be buying in if they were an investor?
Yeah, so this is probably the most important aspect here. Not even that, you know, you might make 100,000. This is focusing on specifically which buildings you should be investing in. And it really comes down to rent control. So any building built after November of 2018, typically there is no rent control, meaning if rents have recovered, you know, next year or the year after, they've gone up $500 a month, you're allowed to adjust that rent to the prevailing market rates, you know, assuming you can rent it out to someone at that time for that amount. Other buildings, older buildings, 5, 10 years old, they're going to be limited to the amount you can increase the rent based on the Ontario guideline. That has typically ranged from about 0 to 2% over about the last 10 years, which works out to $30, $40 a year increase in the monthly rent.
Yeah, so to clarify to everyone, there will be no increases in 2021. They did a rent freeze across the board, but I'm not expecting rental rates to recover in 2021 anyways. If you were to buy a property and by the time you close, your rental increase will be in 2022 anyways, because you'll be signing a 1-year lease. So it doesn't, the rent freeze in 2021 doesn't really impact anyone on here. But that's where the golden sauce is. If you buy in a property, yeah, you gotta take a crappy rent right now, but all you need is a warm body in the body that helps you cover your costs. 1 year's time, get into 2022, get into the spring, summer market of 2022, you see a big jump in rental rates wise. You give 90 days notice to your tenant and you increase it to whatever rent you want. Now, again, there's market conditions to that wise. It's going to be market driven wise. But yeah, you can increase it. There's no rent control on that. So if you were to buy in a building that was older than November 2018, built before that date, you could be stuck at that low rent until that tenant moves out. So that could be for a substantial period of time wise. And then that would impact it'd be a drag on your whole overall portfolio wise. So we're focusing on buildings built that are newer, that are built 2015, past November 15, 2018. So that's a secret sauce. You focus in on those buildings, then you look at the good opportunities in those buildings. The good thing on those two, they're newer buildings. You still have Terry and warranty coverage. You still have very nice low maintenance fees typically in those buildings. You're not looking at having to do a reno on those because again, they're relatively new on the interior of the units wise. So that's the buy short approach. Now the buy long approach, you're like, Alex, I don't want to deal with this stuff right now. You know, I don't want to deal with going to get a mortgage right now. I don't want to deal with a potential empty unit with cash flow issues. I don't want to get a lower rent. I don't want to do that right now. I like an easy life. I don't want to be hassled. I don't want to be stressed. So that's where we go buy long. So we talk about buy long. Everything right now is acute. Expect full recovery in 2022. So the buy long is when you look at the pre-construction market. So if we look at the pre-construction market, units pre-COVID were flying off the shelf. And 20% down over 365 days were standard. We even saw 25% down on some projects wise. That's what builders were asking wise. Now, with COVID coming in, we've seen some softness market wise. So one advantage to the buy long approach, other than you don't deal with any hassles, you get capital conservation now. So what I mean by that is typically, you know, in some cases 20 or 25% the deposits they were asking. The standard now is 15%, scaled over a 3-year period. And what I mean by 3 calendar years. So it's usually a 5% payment, let's say in 2020, 5% payment in 2021, and a 5% payment in 2022. So we get a capital conservation level that we're just moving over to the real estate bank. Number two, if we were continuing on the projection of the pricing pre-COVID wise, the pre-construction pricing will be actually higher than it is. So we are in essence looking at a lower price basis wise than what they would have been priced at if there was no COVID wise. Yes, the pre-construction market will be priced more than the resale market wise, but is not priced as high as it would have been if there was no COVID wise. And when we're looking for the buy long approach, we're looking for those projects finishing 2025, 2026, where the COVID life is well beyond us. And now we're profiting on the recovery. We're well into the recovery. upward tick wise. So if you don't want to deal with all the hassles that come with the speculation of buying something resale right now and some potential vacancy wise, or reduced rental rate, or dealing with, let's say, the mortgage aspect, but you have capital sitting around and you want to move money to the real estate bank, then you'd buy long and look at these great locations in Toronto, whether it's in a downtown core or some other pockets that we've identified wise, and you focus on the buy long approach and looking for those pre-construction opportunities. So that's the buy short approach and the buy long approach, to take advantage of those. And in our emails wise, we'll send people the what we think are the good investment buys on the pre-construction market as well. Amit, I saw your hand up. You wanted to add something.
Yeah, as a transitional point, just to summarize, because to make sure everyone got the concept as well. The pricing on pre-construction, yeah, it seems a little bit higher than today's resales, but that's because the builders also know what they're doing, which is why they price it based on what it's going to be worth in the future. And so, you know, just as an example, if they're selling something for $100 and it should be $96 based on today's price, that's because the builders know it's going to be worth $100 or more in 2022. So just to make sure everyone got that, because that's an important question that I always get as well. And then to throw a question back at both of you is, what I've noticed is the builders haven't slowed down in terms of releasing projects. Like, obviously they've slowed down a bit, but there's still releases coming. There's still land being bought. There's still movement going forward. So when you look at these billion-dollar companies like Menkes and Tridel and Daniels, and you know, Aspen Ridge is coming up with that huge project near the Ontario Science Center, they haven't let off the gas. And so they're got more resources than all of us combined, and they know what they're doing. So how do you address that? Because that's where I find solace in where the future is going to be, because those guys are just still buying everything up and getting ready for 22 to 25.
Yeah, because they know this is just an acute position. They know that this is just a small blip on the radar wise. If you got to look at everything along. If we look at, again, my past presentations wise, when I look at my real estate portfolio, which is at $14 million right now, you know, I look at it, what's my 5-year, 10-year, 20-year, 30-year. The 30 years what gets me excited, because I basically built my pension fund on my own with my condo investments wise. Kyle the same way as he grows his portfolio wise. You know, it doesn't matter what it's worth tomorrow wise. It's what it's going to be worth in the future wise. So if you look at location, okay, go back to the city of Toronto. You go back to the core of Toronto wise. Economic capital of Canada, that's not changing. Population capital of Canada, that's not changing. Most multicultural city in the world, that's not changing. If you look at all these things, you know that there's growth in the future wise. It's all painted right there. And on top of that, if we look at, you know, again, when I use the line, we're safe and boring. If you look at around the world, where do you want to live if I'm looking at immigrating somewhere? Even with the change in leadership south of us, 71 million people still voted for the current regime. There are huge divides still happening in the States. So it's not, you're going to see a wide range of individuals going, well, regime change, I'm going to move over there. There are a lot of people that will still be turned off what's going on down in the States right now. So the States is still not an attractive place to immigrate to. We look at the UK, Brexit wise, same thing in regards to that was all driven by anti-immigration sentiment, was actually Brexit. That's what it was. It's the UK is no longer British. That's what drove the sentiment in regards to the whole Brexit and everything. So you have UK not really an attractive place to go to. So where are you going to go to? Where are you going to immigrate to? Well, Canada, it's safe and boring. You know, nothing terribly exciting happens there, but that's good. I want to fly under the radar. I don't need excitement. I need somewhere to safe that's going to raise my family and they can prosper and then and grow. That's where I want to go. I want to go to Canada. So we're going to continue to be a place where people seek out and want to go to. And on top of that, our currency wise, don't forget our currency play. So our currency compared to the American dollar, compared to the euro, compared to the pound, it's lower. So we're even more affordable to relocate to than these other countries, just for the nature of the currency play, because our currency is valued less than these other countries wise. So we're safe, boring, and affordable. The only thing we have that plays against us is we're cold. But if you're able to put a warmer coat on, then we're an attractive place to relocate to. So back to Amit's question in regards to, you know, builders are still buying land. Like the purchase pricing for land wise, incredible valuations in regards to the actual dirt on the ground wise. So builders are making massive investments in the dirt on the ground wise, because they know what the demographic shifts are moving forward. They're investing for 5, 10, 15, 20 years. We go back to Menkes wise. The Menkes are planning for their future generations. They're already planning for their grandkids. So when their grandkids reach the age to move into the company wise, that they have land that they can develop. This, not a secret. They buy land for their grandchildren wise. The company still exists once the current family is gone and it goes over to the next generation wise. They have land banked for 25 years, 30 years, because they know where the demographic shifts of individuals are going to be. So the answer is yes, builders are still buying. And I've used this line, if you watch our Calgary videos and why we've been buying in Calgary and why we followed Minto. Minto's a $1 billion company. They've been able to invest in distressed assets there. They have a whole team of analysts that are pointing out to them, hey, there's money to be made over there. Well, I might as well just jump on their back and go over there because I don't have a team of analysts. So follow the money, follow where people are investing wise. And we know downtown Toronto isn't going to go anywhere wise. This is where the blip in the radar is. I will counter one thing to Amit though, where you are seeing a slowdown is launch in condos in downtown. So you will see a delay of launches in downtown Toronto by builders wise. But why that's good is because you're going to see a delay of supply. So you're going to see a delay of supply. So there won't be as much supply coming on in the future wise, which will then cause supply issues and increase in pricing. And the whole thing is builders have to make a project financially viable. If I'm building a subdivision, I can sell one house, I can build one house. A condo, I sell one condo, but I still have to build the rest of the condos just to get that one condo. So I have to sell a certain percentage of the condos. And the builder's like, if I can't achieve the pricing that I need to build the building, I'm not going to build the building. Just wait to build the building later. I'm not going to build a building to lose money wise. So that's where there's opportunities. While you're going to see less product downtown coming online. Great. So let's open up questions now to people.
There's a few in the chats that are for the two of you.
Amit's going to have to jump off at noon. So we'll focus on any finance related questions at beginning wise, and then we can move on there.
There's two in the chat, but those are related to you, and there's one in the participants chat again to you. So.
Perfect. I love, okay. So Amit, I'll let you read the questions wise to yourself. I'll read it out to everyone. This is a Helco question, so it's going to rely a little bit on you. I'm very interested in purchasing upcoming pre-construction projects in downtown early next year with my home equity line of credit because I don't want to deal with tenants during COVID, but still want to invest in the Toronto real estate market. Do you see value in purchasing studio 1-bedroom units smaller than 500 square feet as people want more space, or should I go with a unit that's 2-bedroom or bigger wise? So Jason, I'll actually answer that question then. I have studios. I have 3-bedroom units. I have the full spread of units in my portfolio wise. I'm okay with all purchases wise. I do think though, if we're looking at a demographic shift, that there should be a space in the unit for someone to work from home. So I do think a 2-bedroom unit may be something to consider wise, or a 1+ den, because you do want that nook or at least space for someone to work at home, because there will be periods where they're working from home wise. So I think that could be something that you want to focus in on, the 1-bedroom plus den or the 2 bedrooms wise. But again, I don't have any issues buying a studio or 1-bedroom as well. It's just budget driven by what you have to invest wise. So
just from a mortgage perspective, the square footage does become important for some banks. So under a 500 square foot, some banks won't consider a mortgage, but I think the drop bottom size is about 320 square feet. So I know we've seen that before. So as long as the unit's of a certain size, people don't have a problem getting financing or getting a HELOC on it, just so that's there.
Yeah.
The size of the unit can impact the quality of the tenants that you get as well. For a studio, typically it might be a student, a new immigrant to the country, someone starting out in their career. Whereas say a 1-bedroom or 2-bedroom, it's typically more we see a professional, maybe a family moving in there. So just need to make sure you're comfortable with the profile of the potential tenants you may get as well.
Yeah. Okay, so do you think the opportunities will present themselves for Toronto condos winter 2020 or 2021? I don't know where the bottom is. So to answer where the bottom is, we will be presenting the opportunities as we see them. If you try to time the bottom, you're going to miss out. So to try to, $10,000 may seem like a big number wise, but to try to get it right at the bottom to try to make an extra $10,000, you may miss out on $100,000. So I don't know when really the opportunities come when they present themselves. That's the best thing. So I don't try to take, if you see something you like and it's an opportunity, jump on it at that time. So Jason asks, if there is a property being listed that is distressed, the owner would be looking for a quick sale, what would your approach be? Ask them what they want for it and then reach out to me. that what I mean by that is I'll tell you if it's a good deal or not. That's basically the best approach wise. Going, just ask them what they need is, and they'll tell you if it's a good deal or not. I do notice there was a question.
There was 2 questions from Harlan saying, I don't have a mortgage. Could I borrow from my HELOC to pay for down payment? And then a follow-up was also on my primary residence. Yes, absolutely. There was a short period of time when COVID started that the banks had stopped HELOCs to be used as down payment, but that policy has now been reversed. The banks were just trying to avoid any run on the bank as people were panicking with their HELOCs. But so short answer, yes, you can use a home equity line of credit for down payment. It's considered an allowable source.
And we'll add on to that, and Em and I have conversations in other web. If you're going, let's say pre-construction wise, you can use a down payment from your home equity line of credit from your house to buy pre-construction condos, and then you can write off the interest wise. The key thing is how to do that is when you're buying the pre-construction condo, the check has to come directly from your home equity line of credit. And then there's a line on your tax return where you're going to write off that interest on your tax return. And if the government ever came back and asked you questions, you would show them that the checks went right to the builder, and then they would approve that interest as the write-off if you got audited wise on that. So
correct.
100% you can write off that interest if you want construction wise. Obviously resale is wise as well. You just have to show that the interest is being used for an investment related activity wise. Pros and cons of owning property under oh yeah, I don't think you need to do this. Pros and cons of owning under a limited liability corporation for each separate. You don't need to own, you don't need a holding company for every single property wise. You can group a number of properties in one holding company wise. Now, Amit, do you want to touch on that? Because when we talked, you did have some updates on holding companies and banks.
So I think we've had a number of seminars where we've talked about this. So I would definitely advise people to definitely take a look at our seminars on this. But to answer it in a minute, holding companies have a simple purpose. They're there to limit liability. In the residential space, the liability really doesn't exist. You can't get sued if someone falls. They have OHIP. If something happens to the property, there's home insurance, etc. There are pros and cons to limited liability. There are pros and cons to corporate held properties. But the long and short of it is it's good for some people and it doesn't make sense for others. Yeah. And we could talk about that for half an hour or so.
Yeah, for sure. But I would say if you are focusing on doing a holdco, you don't need to do a holdco for every single
Absolutely.
property. No. Group multiple units.
The purpose of the holdco is to limit liability, and that's accomplished as soon as you have a holdco. But we've gone back and forth on this before. So yeah. For residential properties, there's pros and cons.
Have a question here in the chat. Would you get back the value of parking if you buy it for $45K or above in downtown or rent from other units? $45K seems like today a decent price for parking wise. But when we're looking at downtown parking and other buildings where it's 60, 70, 80, you're better off on the rental side versus the ownership side. I will put an asterisk beside that. If you're buying a larger unit, you would want to buy parking resale component of that when you sell that unit. If you're a unit where there's typically an expectation that the unit comes with a parking spot on the resale market wise, you could be hindering the resale value of the property because it doesn't have a parking spot, and then someone won't buy it because they want a parking spot, a title parking spot to that. But when I typically run the math, it makes more sense not to buy the parking spot than to buy the parking spot. It's better to rent it out.
But banks also finance the parking spot too.
Yeah,
they'll lump it with the value, so it's not an out-of-pocket expense.
Yeah, and I'll also add though there is maintenance fee. So just something to factor in when you're doing that calculation. Okay, from Martin, condo rent has gone down substantially and makes cash flow negative. What do you think in investing in a townhome? Do you forecast rent to go up for the townhome? Well, the townhome's hot. So the townhome market, the purchase price has gone up. Everyone wants the townhome. So yeah, rents have gone down on the condo wise, but again, it goes to my analogy going, it's not going to stay that way. That rents are going to go back up and purchase prices are going to go back up. So I'm looking at where's my dip in my opportunity wise, and my dip in my opportunity is in the condos wise. So if I'm down $200 to $300 a month on cash flow wise, but I'm going to make $100,000 on appreciation short period of time because we're dealing with an acute period, then $2,400 or $3,600 versus $100,000, that's an incredible return wise. I don't have anything against townhome investments wise, but that's the hot item right now. So if you buy the hot item, you're going to pay a premium for that. If you go buy Apple stock right now, that's the hot item. But if you go buy oil and gas, well, actually, I can tell you, if you go buy a REIT, that's on sale. So I bought REITs. I bought REITs on the stock market, which are paying me. I bought RealCan. I'm getting a 10% dividend yield on the property, and it's 50% of the value it was. Their land holdings alone can cover out all the shareholders. So if they sold all their land, everyone could be paid out the purchase price of their stock. So I'm taking a risk in investing them, but they're paying me 10% essentially on my investment. So that's where I look where the opportunities where other people aren't, because that's where you're going to see the bump pricing wise. If the long term or even the short term, what I mean by short term, 18 months. So, but I'm gonna let Amit run because I know he has to go. I don't want to have to sprint out of there. Amit, thank you for taking the time and answering
Thank you so much.
these mortgage related questions. But so this will be recorded for everyone. Kyle, I'll stay for a little bit longer to answer these, but Amit will be back.
Thank you so much, guys. See you next week.
And we're looking forward to speaking with him again. Okay, see you.
Bye, guys.
Thanks, Amit.
Alex and Kyle, are you targeting specific areas downtown to look at, or are you looking at downtown as a whole? We're just always where are the opportunities. So if we go specifically downtown, if I want to talk about, it depends if I'm looking resale or pre-construction wise. Pre-construction wise, I know there's a condo building called Jack, where I've done the analytics for the area wise. We've sold in that area before. We've seen high pricing in that area. So if we're looking at downtown pre-construction, we see Jack condos as a great opportunity for investors to buy long in. If we're looking on the resale side, we're specific to the buildings built after November 2018. Once we do that, then we're going to look at the areas. Well, which areas do we prefer in regards to when we comparing those other buildings? One building's development, particular wise, Minto West Side, I think there's incredible opportunity in. That one there is at Bathurst in front. It meets the criteria of when the building was completed wise, and beside it I have the massive Tridell Well development, and then in the future wise I'll have a future subway stop at Bathurst and King Street. So that could be an example of something wise, but anything in the downtown is going to have value in the long run wise. There will be other areas I like better than some, but specifically it's going to be building related, non-rent control buildings.
And especially for the downtown market, that's where it's been depressed the most. it's had the most significant impact due to COVID, and that's where we see the opportunity. So most of the resale opportunities are going to be in the downtown market because of the COVID impact.
Okay, so to Jason, great question in regards to more asking about features wise. So advanced water, air filtration. I don't think people are going to care about that. But automated parcel pickup, I do think that'll be very, very important. I think I know, just again from the demographics of my specific household wise, my wife, we don't go grocery shopping anymore. Groceries are all delivered to our door. She does all her purchases through Longo's Wise Grocery Gateway. She's tried them all. She's happy. She's most happy with them. Yeah, I see that one there being important aspect. The other amenity, I think, giving space for people to work from home. So meaning that is, let's say someone does work in or live in a studio wise, but they want to go to a different space within their building wise to do work. I think that co-working space in buildings will be something that'll be attractive to people in the future wise. I don't think the advanced water and air filtration wise would really have an impact unless I was in a building that was focused on affluent individuals that are older. And what I mean by older, there may be some health risks, that kind of thing, but I don't see it, there being something for people in the future wise in that.
We have seen some of these amenities being built into pre-construction condos. One that I bought, Line 5, has a cold and a hot food pickup area, for Uber deliveries. It also has an Uber area that people can actually get picked up at the building, versus having to hail them from the street and meet them outside. So the condo industry is adapting to a lot of these demands. Now, is it going to be make or break for a lot of people? Probably not. It's probably the overall package that the building is delivering that people would look at.
What are your thoughts on the Bay Street corridor around UOT? Seems depressed due to foreign students not being around. Oh, I have one. I have one right. This the great thing is I can tie this into both questions. Talking about a location-based question wise, the Bay Street corridor. And we've also, I'm going to address the smaller unit question, installing a Murphy bed wise. Both are my unit wise. I can relate it to both questions. So I have a unit at YC Condos, 7 Grenville. So that's at Young and College, 1 street over from Bay. I have a studio there. I was getting $2,400 a month furnished for that studio up until September 1st. I could not for the life of me rent it furnished. I had to rent it for $1,450 unfurnished wise. So a $950 drop per month wise, and I'm taking all the furniture out. So yeah, I see opportunity in regards to it's a very, very attractive corridor wise. Once immigration opens back up, not only from foreign students wise, but just immigrants in general wise, they do like that Bay Street, that Yonge Street corridor, central location. That's blue chip. So I do see opportunity there. Jason, to answer your question, I was doing very, very well when I installed furniture. My idea was that the exact effective floor space wise, I wanted to maximize the floor space. I had a very, very excellent layout, and I felt the person that was going to bring furniture in would bring the wrong furniture in. The only issue is once COVID hit, no one wanted a furnished unit, and the unit and then Airbnb units that came on the market, those impacted things and everything like that. So the furnished market took an incredible, I shouldn't say a big hit in the market wise. So I was forced to unfurnish my unit. So it's a difficult one to answer. So I guess long term, I think there's value wise. Short term, there could still be value wise because again, you're putting the bed in the exact space that it should be. But then does someone want to bring in their own bed? It's a little bit of a difficult to answer question was, and I know why you're asking the question. So reach out to me personally wise, but it's debatable right now. But I would say long term, yeah, for sure. I just don't know on the short term aspect.
Any upgrades like that typically allow you to distinguish yourself or differentiate yourself from other units on the market as well. But it really depends. You don't want to spend too much money on a custom installation or a feature that people may not care about. So you need to invest smartly.
And then they break it. So Jason, I would say that I didn't do a Murphy bed. That was an option for me. I did not invest in a Murphy bed, but I invested in a really nice bed, which had drawers underneath, which now I'm taking out, but I'm just setting it up in my house wise. So maybe you want to invest in something that's a little more mobile wise. That's not specifically limited to that space. And that's kind of the happy medium between the two. So let's say it's not working out and you needed to remove it. It's not a difficult thing to remove. So I think that would be the answer to my question wise, and going for the actual custom for the space wise, and then someone ends up breaking it or it's not something that someone wants and you don't have the ability to remove it. Maybe that's something to do. I think that answers all the questions here. Thank you everyone for attending wise. As we said, we are gonna have a running list of what each week where we see opportunities coming out that may come out. We'll do it at the same time every week wise, probably maybe a Tuesday or Wednesday that'll be sent out wise. And then that'll show you where the opportunities are. So that's on the buy short, and then the buy long, we'll send links to what we see as the good opportunities in the Toronto market wise to, if you don't want to deal with the hassle of tenants and everything right now, the buy long opportunities wise, because we do believe in the long-term fundamentals of the market. And we'll be doing this presentation again next week. So for those that want to double down on us, feel free to sign up for that as well. Thanks again to everyone for tuning in. We'll be in touch soon. Okay, bye guys.
Bye everyone.